Homebuyers face record high home prices and mortgage rates at the same time. That's pretty crazy. Record high home prices and record high mortgage rates. There are not enough homes in this country, and that's pushing home ownership out of reach for too many families, with an estimated shortage of 4.5 million homes in the U.S., Tom.
Well, right now, what it says, what we've been saying for a while, it says if you can find a great rental in the market that you are in and maybe live below your means, under-consume housing, that's the play, and that's what I recommend to people right now.
Home buyers are facing a perfect storm of record-high home prices and mortgage rates. It's a situation that has put the dream of home ownership out of reach for many families across the country. Imagine you're ready to buy your first home. You've saved for years, carefully budgeting every penny, only to find that the house you could afford just a year ago is now beyond your reach. It's a harsh reality that's hitting many aspiring homeowners today. So, how did we get here? The current state of the housing market is the result of several converging factors. First, let's talk about mortgage rates. The 30-year fixed-rate mortgage has been hovering around 7% or higher, a significant increase from just a few years ago. This spike in rates has made monthly payments much higher, even for modest homes. Combined with already high home prices, the affordability of homes has plummeted. But it's not just about the numbers. This crisis is affecting real people. Families are struggling to find homes within their budget, and many are being forced to rent longer than they planned. This dynamic creates a ripple effect across the entire housing market, impacting everything from home sales to rental prices. Stay with us, because we're just scratching the surface. In the next section, we'll delve into the regional variations in the housing market and how different areas are experiencing this crisis in unique ways. You'll be surprised to learn which regions are seeing price drops and why. So, if you want to understand the full picture, don't skip any part of this video. Remember to like, share, and subscribe to our Economy Explorer for more insights. Your support helps us bring you the most relevant and up-to-date information. Now, let's dive deeper into the heart of this housing crisis. Current situation, mortgage rates, and home affordability. Imagine you're at an auction, bidding on an item you've always wanted. Suddenly, the bids skyrocket, doubling and tripling in moments. That's what home buyers are experiencing with mortgage rates today. In the past year, the 30-year fixed-rate mortgage has surged to around 7% or higher, a stark contrast to the 3% rate seen just a few years ago. This dramatic increase has made monthly mortgage payments substantially higher, putting enormous financial pressure on buyers. But why are mortgage rates so high? The Federal Reserve has been raising interest rates to combat inflation, which hit a 40-year high in 2022. As the Fed increased the federal funds rate from near 0% in early 2022 to 5.25%, 5.50% by mid-2023, mortgage rates followed suit. This correlation between federal interest rates and mortgage rates has created a challenging environment for anyone looking to buy a home. Just think about it. A house that cost $1,500 a month in mortgage payments a couple of years ago might now cost $2,000 or more. This spike in costs is squeezing family budgets and pushing the dream of home ownership out of reach for many. So, what does this mean for the average home buyer? If you're currently renting and thinking about buying, the high mortgage rates mean you need to save more for a down payment and budget for higher monthly payments. This is a significant hurdle, especially for first-time buyers who may not have built up substantial savings. It's a bit like training for a marathon only to find the finish line moved another 5 miles away. Impact on the housing market. The impact of these high mortgage rates extends beyond individual home buyers. The entire housing market is feeling the strain. High rates have slowed down the rate of home sales, as fewer people can afford to buy. This slowdown in sales creates a ripple effect throughout the economy. Real estate agents, construction workers, and home improvement stores are all seeing reduced business as fewer homes change hands and fewer new homes are built. Moreover, high mortgage rates and home prices have led to a significant affordability crisis. According to recent data, home ownership rates have dipped slightly, and the percentage of income that families must allocate to housing costs has increased dramatically. This affordability crisis is particularly acute in urban areas where home prices were already high before the recent rate hikes. It's like trying to fill a leaky bucket. No matter how much water you pour in, it never seems to stay full. But here's where it gets interesting. While some areas are struggling, others are starting to see a decline in home prices. In coastal regions like Florida, where prices surged during the pandemic, we're now seeing a significant drop due to the increasing risk of climate disasters and skyrocketing insurance costs. This trend is a double-edged sword. While lower prices can make homes more affordable, the underlying risks and costs can still make these areas less attractive. Regional variations. The story of the housing market isn't uniform across the country. Just as a storm can hit one town hard while leaving another untouched, regional variations are creating vastly different experiences for home buyers. In some areas, particularly those that saw massive price increases during the pandemic, prices are starting to fall. Coastal Florida, for instance, is experiencing notable price declines due to the rising risk of climate disasters and the high cost of home insurance. Conversely, more affordable metros that are climate resilient, like Albany and Rochester in New York, are seeing price increases as they become more desirable. This divergence is driven by several factors. Firstly, the pandemic reshaped where people wanted to live. Remote work allowed many to leave expensive urban centers for more affordable areas. But as hybrid work models become the norm, some of these migrations are reversing. Secondly, local economic conditions and policies play a significant role. Cities with aggressive building policies and lower costs of living are attracting more residents, while those with restrictive zoning laws and high costs are losing them. It's a bit like a chess game, with people constantly reassessing their best moves based on changing circumstances. Now we've seen how high mortgage rates and home prices are straining budgets and reshaping the housing market. But what does the future hold? Are there any signs of relief on the horizon? And how are government policies likely to impact this situation? In the next section, we'll explore the economic influences shaping the housing market's future and the potential for rate cuts that could change everything. Economic influences. Federal Reserve policies and inflation control. The role of the Federal Reserve in shaping mortgage rates cannot be overstated. As mentioned earlier, the Fed's aggressive rate hikes have been a key factor in the rise of mortgage rates. The goal has been to control inflation, which soared to 9.1% in June 2022, the highest in 4 decades. By increasing the federal funds rate, the Fed aims to cool down the economy and bring inflation back to manageable levels. But these higher rates have a direct impact on the cost of borrowing, including mortgages. Interestingly, there is a silver lining to this cloud. As inflation begins to moderate, there is growing speculation that the Fed might start cutting rates in 2024. Some economists predict that mortgage rates could fall to around 6% or even lower by the end of the year. This potential decrease could make home buying more affordable and revive the housing market. Imagine the relief for buyers who have been priced out of the market due to high rates. A drop in rates could be the key that unlocks the door to their dream home. Government policies. Beyond the Fed's actions, government policies will play a crucial role in addressing the housing crisis. As we approach an election year, both major political parties are likely to propose bold housing initiatives to win over voters. Democrats may focus on subsidies for first-time homebuyers, promoting inclusionary zoning, and funding housing vouchers. These measures aim to make housing more accessible and affordable for low and middle-income families. On the other hand, Republicans are likely to push for reducing regulations that limit development, hoping to increase the supply of homes and lower prices through market forces. These policy proposals will be critical in shaping the future of the housing market. Effective policies could help mitigate the affordability crisis and provide relief to struggling homebuyers. However, the implementation and impact of these policies will depend on the political landscape and the cooperation of local governments. Regional analysis. Coastal Florida, a tale of boom and bust. Imagine living in a picturesque coastal town, enjoying the sun and sea, only to find your dream home threatened by rising insurance costs and climate risks. This is the reality for many residents in coastal Florida. During the pandemic, areas like North Port and Cape Coral saw a surge in home prices as people flocked to these beautiful locales, drawn by the promise of remote work and a better quality of life. However, this boom has turned into a bust. The increasing frequency and severity of climate disasters have made these areas less desirable, driving down home prices. Moreover, insurance costs have skyrocketed, further deterring potential buyers. The risk of hurricanes and flooding has made it difficult for homeowners to secure affordable insurance, leading to a drop in property values. For instance, homes that were once highly sought after are now losing value rapidly as buyers factor in the higher costs of insurance and potential repairs. This shift highlights the precarious balance between natural beauty and the harsh realities of climate change. Boomerang migration, returning to urban centers. Let's take a trip back to the early days of the pandemic. Many people left expensive urban centers for more affordable and spacious suburban and rural areas, taking advantage of the newfound flexibility of remote work. Fast forward to today, and we see a new trend emerging: boomerang migration. As companies enforce hybrid work policies, many remote workers are returning to cities like Seattle and New York. This reverse migration is reshaping the housing market once again. The return to urban centers is driven by several factors. Firstly, the desire to be closer to work as remote work becomes less common. Secondly, the amenities and lifestyle offered by big cities, such as dining, entertainment, and social opportunities, are drawing people back. This shift is increasing demand in these urban housing markets, leading to rising home prices and rental rates. The cycle of migration and reverse migration underscores the fluid nature of housing demand in response to broader societal changes. Affordable metros, rising stars. While some regions grapple with declining home prices, others are emerging as rising stars. Affordable metros that are climate resilient and offer a high quality of life are becoming increasingly attractive to home buyers. Cities like Albany and Rochester in New York, as well as Grand Rapids in Michigan, are seeing a steady influx of new residents. These areas offer a compelling combination of affordability, job opportunities, and safety from extreme weather events. In these rising metros, local governments have adopted progressive policies to encourage development and maintain affordability. For example, some cities have implemented land value taxes to promote building and reduce housing costs. These measures, coupled with the natural advantages of a lower cost of living and fewer climate risks, are making these areas hotspots for new homebuyers. As more people discover the benefits of living in these regions, we can expect continued growth in their housing markets. Economic influences. The role of the Federal Reserve. Imagine a vast, intricate machine where every cog and wheel must turn perfectly to maintain balance. The Federal Reserve is one of the most critical cogs in this machine, particularly when it comes to the housing market. Over the past few years, the Fed has played a significant role in shaping mortgage rates through its monetary policy. In response to soaring inflation, the Fed raised the federal funds rate from near zero in early 2022 to 5.25%, 5.50% by mid-2023. This series of rate hikes was aimed at cooling the economy and bringing inflation under control. The immediate consequence of these rate hikes has been a sharp increase in mortgage rates. The 30-year fixed-rate mortgage, which hovered around 3% before the pandemic, has climbed to around 7% or higher. This drastic rise has made home loans more expensive and monthly payments harder to manage for many prospective buyers. But here's the silver lining. As inflation begins to moderate, there is growing speculation that the Fed might start cutting rates in 2024. If this happens, mortgage rates could fall, making home ownership more affordable once again. The Federal Reserve's decisions are pivotal, not just for mortgage rates, but for the overall economy. Lower rates can stimulate economic activity by making borrowing cheaper, which can, in turn, lead to higher consumer spending and investment. This delicate balancing act is crucial for maintaining economic stability, and its effects ripple through every corner of the economy, including the housing market. Government policies and housing affordability. Let's take a step back in time to the New Deal era, when the U.S. government introduced sweeping policies to address the housing crisis of the Great Depression. Fast forward to today, and we see a similar urgency in addressing the current housing affordability crisis. As we approach an election year, both major political parties are gearing up to propose bold housing initiatives to attract voters. Democrats are likely to focus on subsidizing down payments for first-time homebuyers, promoting inclusionary zoning, and funding housing vouchers. These measures aim to make housing more accessible and affordable for low and middle-income families. On the other hand, Republicans are expected to push for reducing regulations that limit housing development. By cutting red tape, they hope to increase the supply of homes and bring down prices through market forces. This approach emphasizes the importance of boosting housing construction to meet the growing demand. Both strategies have their merits and could significantly impact the housing market, depending on their implementation and political support. Local governments also play a crucial role in shaping housing affordability. Cities like Minneapolis and states like Oregon and California have made strides by ending single-family-only zoning and encouraging multifamily developments. These policies aim to increase the housing supply and make urban living more affordable. The effectiveness of these measures often depends on local economic conditions and the political will to enforce them. The impact of inflation and interest rates. Consider the ripple effects of a stone thrown into a pond. Similarly, inflation and interest rates create ripples that affect every aspect of the economy, including the housing market. Inflation, which peaked at 9.1% in June 2022, has been a significant concern for policymakers. High inflation erodes purchasing power, making everything from groceries to home loans more expensive. To combat this, the Federal Reserve's rate hikes were designed to cool the economy and bring inflation under control. As inflation begins to moderate, there's cautious optimism that the Fed might start cutting rates in 2024. Lower interest rates would reduce borrowing costs, making it easier for people to take out mortgages and buy homes. This potential decrease could revitalize the housing market, which has been under pressure from high mortgage rates. However, the timing and extent of these rate cuts remain uncertain and will depend on various economic indicators, including inflation trends and employment data. Future predictions, potential rate cuts, and their impact. Picture this. It's mid-2024, and after a series of intense discussions and market fluctuations, the Federal Reserve finally decides to cut interest rates. This decision sends ripples through the financial world, with potential homebuyers and investors watching closely. The anticipation of rate cuts has been building as inflation begins to cool, and the economic pressures of high interest rates have become increasingly burdensome. Experts predict that mortgage rates, which have been hovering around 7%, could drop to around 6% or even lower by the end of the year. So, what does this mean for the housing market? A reduction in mortgage rates would make borrowing cheaper, potentially reviving the housing market by making homes more affordable for buyers. Lower rates mean lower monthly payments, which could allow more people to qualify for mortgages and stimulate demand for housing. This increase in demand could stabilize or even drive up home prices, especially in regions where prices had previously been declining due to high rates and affordability issues. However, this scenario also comes with its own set of challenges. While lower rates can boost demand, they might also lead to a temporary spike in home prices as more buyers enter the market. It's a delicate balance that will require careful monitoring and adjustment by policymakers and market participants alike. Government policy and housing affordability. Let's take a step back and consider the broader political landscape. As we approach the next election cycle, housing affordability is set to become a hot-button issue. Both major political parties are gearing up to propose bold housing policies to attract voters. Democrats are likely to focus on measures such as subsidizing down payments for first-time homebuyers, promoting inclusionary zoning, and funding housing vouchers. These initiatives aim to make housing more accessible to low- and middle-income families, potentially easing the affordability crisis in high-cost areas. On the other hand, Republicans may push for reducing regulations that limit housing development. By streamlining the approval process for new housing projects and encouraging private investment, they hope to increase the supply of homes and bring down prices through market forces. This approach could help address the supply-demand imbalance that has been driving up prices in many regions. The effectiveness of these policies will depend on various factors, including their implementation and the cooperation of local governments. Additionally, the outcome of the presidential election will play a crucial role in shaping the future direction of housing policy in the United States. Economic stability and market predictions. Beyond government policies and interest rates, several other economic factors will influence the housing market in the coming years. The overall stability of the economy, job growth, and consumer confidence are all critical components. If the economy continues to stabilize and grow, we can expect a more robust housing market with increased transactions and stable price growth. Conversely, if economic conditions worsen, with rising unemployment or another recession, the housing market could face further challenges. One intriguing prediction is the potential for regional disparities to widen further. As climate risks become more pronounced and remote work continues to influence migration patterns, certain regions may see significant shifts in housing demand. Areas that are considered climate resilient and offer a high quality of life at a lower cost may attract more residents, driving up prices in these markets. Meanwhile, regions prone to climate disasters or economic instability may experience slower growth or even declines in home values. Navigating the mortgage maze. As you stand at the entrance of a complex maze with towering hedges blocking the view ahead, navigating the current housing market can seem daunting. However, with the right strategies, you can successfully find your way through. Here are some practical tips to help you make informed decisions, whether you're looking to buy a home, refinance your mortgage, or simply manage your finances better. For prospective home buyers. Buying a home in today's market requires careful planning and strategic thinking. High mortgage rates and home prices mean that affordability is a major concern. One of the most important steps you can take is to get pre-approved for a mortgage before you start house hunting. This not only gives you a clear idea of your budget, but also makes you a more attractive buyer to sellers. Additionally, save as much as possible for a down payment. A larger down payment can lower your monthly mortgage payments and potentially get you a better interest rate. Consider the location carefully. Look for regions that offer a balance of affordability, job opportunities, and a high quality of life. Emerging metros like Albany, Rochester, and Grand Rapids are becoming popular due to their lower cost of living and climate resilience. Evaluate the local housing market trends and consult with a knowledgeable real estate agent who understands the nuances of the area. For homeowners. If you already own a home, this could be a good time to refinance your mortgage, especially if you anticipate interest rates dropping in the near future. Refinancing can lower your monthly payments and free up cash for other expenses. However, make sure to consider the costs associated with refinancing, such as closing costs and fees, and calculate whether the long-term savings outweigh these initial expenses. Another key piece of advice is to leverage your home equity wisely. Many homeowners have built significant equity in their homes over the past few years. This equity can be used for home improvements, consolidating high-interest debt, or even investing in other opportunities. However, be cautious not to over-leverage and ensure you have a solid repayment plan in place. Financial management. In addition to specific actions related to buying or owning a home, managing your overall finances is crucial. Start by creating a detailed budget that accounts for all your income and expenses. Use this budget to identify areas where you can cut back and save more. Building an emergency fund is essential, especially in uncertain economic times. Aim to save at least 3 to 6 months' worth of living expenses to cushion against unexpected financial setbacks. Consider speaking with a financial advisor to get personalized advice tailored to your situation. They can help you create a long-term financial plan that includes saving for retirement, investing, and managing debt. Remember, a solid financial foundation makes it easier to navigate the ups and downs of the housing market. At the exit of a complex maze, you can now see the path you've navigated. We've explored the housing market's intricacies, including regional variations, economic influences, and practical advice for buyers and homeowners. High mortgage rates and soaring home prices have created a challenging environment, with the Federal Reserve's policies playing a crucial role. Regional disparities highlight the diverse impact of the crisis, and upcoming economic policies will shape the market's future. As we conclude, the housing market is at a pivotal moment. Decisions by policymakers, the Federal Reserve, and individual buyers will influence its future. In our next video, we'll explore emerging trends that could shape the market in the years to come. Your journey through the housing market maze doesn't end here. Stay informed and make the right decisions with our insights. If you found this video helpful, please like, share, and subscribe to Economy Explorer. We value your input, so don't forget to comment with your experiences and tips to help build a community of informed viewers.